No, this time it's different. It's going to blow. 2 years, it's up more. 1 year, it's up more. And I said, what the heck? Let's go back 25 years, quarter of a century. Gold's up 11-fold and S&P is up 4-fold. It's going to blow to the upside. It shot up into, and the gold miners like GDX at that point in time was 31.5. Okay, right now we're trading just short of 50. Okay, nobody's, the bloody fact that gold is beating the pants off the stock market, and it does it consistently. So.
In today's news recap, DeSantis signs bill recognizing gold, silver coins as legal tender in Florida. Governor Ron DeSantis signed a bill on Tuesday to recognize gold and silver as legal tender in Florida and make them free from sales tax. Under HB 999, gold and silver coins that meet specific purity standards can be used for payments, NBC affiliate WESH reports. So you're going to be able to conduct transactions in these precious metals, DeSantis said, at a news conference in Apopka. The governor said the Sunshine State would be the largest to sign such legislation. State Representative Bill Bankson from Apopka sponsored the bill. He said it aims to eliminate the tax burden and make it a functional means of transaction between willing parties. Florida stands firmly for freedom, economic self-determination, and resistance to government overreach. But for too long, outdated regulations and unnecessary sales taxes have made it impractical for Floridians to enter the gold and silver market. The governor wrote in a post on X, I signed HB 999 today to change that by initiating the process to recognize gold and silver as legal tender in our state and with rule ratification from the legislature free from sales tax. The new rules would have to be ratified by the state legislature. If lawmakers agree, the law would take effect on July 1st, 2026. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Which I've included in the charts I sent you as a GDX versus gold going back to 2020. There's a trend line that an idiot could draw, but it's on the spread chart. And that spread is a week old, so it's actually pushing up toward that trend line as we speak. That trend line is a multi-point, very clear structure. In other words, if this were a price chart, you'd say, ooh, I'm going to buy the breakout. Okay, I think we're on the cusp of that breakout, at which point the miners, while they've been strong, like over the last year, it was 31.5 when we said buy in March. We're resuming the bull trend, we said. Well, you've gone up a nice percent, right? And beat the heck out of the stock market. But it's going to beat gold at that point. And I think what that indicates, and this is what we've been arguing, is that it's highly likely that when the miners shift to the upside, it will be one of the causal factors will be money moving out of the stock market. Now, that spread has started to firm since late last year. The miners versus gold. You'll see on the chart, it's come up. It's not broken out yet, but it's risen. Well, what's happened in the stock market over those months? It dropped, okay. And the pullback we just had in the GDX versus the gold spread, minor little pullback last month, and it may not be in effect right now, frankly, was when the stock market rallied, okay. But when the money flows out of the stock market, it goes somewhere else. And most investors and large asset managers aren't prone to go buy silver futures or gold futures or even just raw bullion. They want to own stocks. And, some of these stocks put out good earnings and dividends, Newmont, for example. I think that flow is probably one of the factors that will cause the miners to reassert themselves on a spread basis versus gold. Is simply the money moving out of this sinking battleship and moving over into this tiny little category. And it's a tiny category, you know that. It's a wet bar of soap issue if you suddenly get money moving into it. And I think that's what this chart in effect says, is that stock market break that is underway, we argue, despite the recent rally, will generate that. And there's other factors as well that are in play that have not been in play for a while. One is the T-bond market. We've been arguing for a couple of weeks. It looks like there's a T-bond crisis shaping up. And now suddenly I hear on the news today, oh my gosh, something's wrong over there. We've been warning something's wrong over there. The other factor is the dollar. The dollar was stuck in a dull range for about 2.5 years, 7% range. It was up, down, up, down. I mean, the yen and the euro were effectively dull as well, because that's what comprises most of the dollar index. We got bearish in April. The close of March, dollar index was 104. Why? We'd broken an annual momentum uptrend that went back more than 2 decades. In other words, you look at the dollar and you don't see the breakage. We look at the annual momentum and you see this massive multi-year breakage. We went all the way down to 98 after that break, which also took out some price floors on the dollar. It had been around 100 for the past couple of years. It went to 98, so they even broke the price floors. And then they had a 3-point rally up to 101. Right now we're back down near 99 again. I'm going to bet if you ever touch that low tick again, the price guys are going to wet their pants. Meaning you go back and touch 98 again, the price guys are going to say, oh gosh, that rally failed. And when the dollar gets volatile on the downside, that suddenly becomes an upset factor for a lot of other categories, particularly foreign investors who own our bonds, foreign investors who own our stock market. All of a sudden, they're getting gut kicked by the money unit they had to use to buy it. You get the point. Okay. So I think that's another factor out there that could help move the money out of stocks, out of bonds as well, into the monetary metals.
In today's news recap, Citi bullish on gold. Americans purchase hit record high. Citi, the American multinational lender, reaffirmed its short-term gold price target at $3,500 an ounce, citing the recent increase in tariffs and significant geopolitical risks. According to a note released on Sunday, the bank raised its estimate of gold prices from $3,000 to $3,300 per ounce to a range of $3,100 to $3,500 per ounce. The U.S. bank maintains its long-term cautious approach to gold despite the upgrade. The bank cites 2 main explanations: the potential for growth and associated equity risks diminishing as U.S. households now own more gold than they had in 50 years. The Federal Reserve lowers interest rates, and the midterm elections draw near. The short-term price targets for palladium and platinum remain $1,050 and $900 per ounce, respectively. Citi believes that a sustained upward trend requires a genuine improvement in end-use demand, and the recent platinum rally is viewed as headline-driven. The palladium rally represents yet another opportunity, according to the bank. Citi has maintained a bullish outlook on gold, initially increasing its target price to $3,500 per ounce in April 2025. On April 22nd, concerns about the Federal Reserve's independence caused the price of gold to surpass its previous record. Citi called for a period of consolidation for gold prices as trade tensions began to de-escalate and lowered its short-term target to $3,150 per ounce, which was reached on May 15th. In the second half of 2025, Citi predicts that gold prices will continue to stabilize at their current levels. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics Handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
We update all the commodities every month, and uranium's one of them. And including on that one, we'd run URA, which is the ETF of the uranium miners, and producers. Context. MSA turned long-term bullish on uranium coming up through $20 back in 2017 or 18 it was. We stayed long-term bullish. Annual momentum had broken out. That's a very long-term trend metric. When you measure price versus a 3-year average, not just getting above the average, but the structure that's built in the momentum chart. We saw a positive momentum breakout 7 years ago, okay, and we went to over 100. And during that process, there were many zigzags in uranium, okay, none of which broke the annual momentum trend. They were just counter trend sell-offs. Last August, coming down through 85, we said, watch out, we're going to get a correction. And it's probably going to take you down toward the 3-year average or the 36-month average, which in fact we did. We got slightly below them, no big deal. Now we're reasserting ourselves. We thought that would be around where you found the support, like in the upper to mid 60s on uranium. I think right now we're back up in the 70s, right? Okay. I think that was the corrective low. I think uranium is now a buy. The question is, how long does it take to really get itself going again, even if that was the low? Okay, let's assume that was the low. We do. Does it mean it's an instant buy? You're going to go back to the high right away? I don't know. I think you may have to work for it. But from an investment point of view, I think that was the correction. That was it. And the long-term trend remains up. URA is, it sort of behaves like the gold miners. You know how they panic sometimes? Gold will drop a little bit and they'll puke. Gold will go up a bit and they explode. You know, URA got way ahead of itself a handful of months ago. It got way up above its recent highs while uranium was dropping. I said, what are these guys drinking? You know, uranium's correcting and they're trying to make a new high. Well, sure enough, that new high puked. They dropped URA down hard. So anybody in URA should have just looked over at the other chart of uranium. So what's going on here, guys? It's a little bit too much too soon. I think URA is stable now. I think it'll reassert itself. But in watching URA, and we put out specific numbers on it every month, we update them. And it's not far below some numbers that say, okay, we're coming back up. But if you're in URA, pay attention to uranium. Make sure it's agreeing with your uranium holdings. And I think it's back in line with uranium now because it had that give up. But I think right now uranium in the category is basically a safe and probably a good investment place. Not as good as silver, okay, but a good place to be if you want to be. And I think this is true basically with most commodities as well. Index. It's not excessively heavily weighted for energy, for example. Some other commodity indexes are overwhelmingly energy. But in the last big surge we had in commodities, which was from October 2020 when we got major bullish, we said there's an explosion about to occur. Bloomberg went from $70 to 140. It doubled. Well, crude oil was a leader in that group. The front end of that leadership among the commodities, basically all of them went up, okay? But it was definitely an outperformer. This time it's a real laggard because while you've got grains bottoming and other commodities, but copper especially, crude oil had that little plunge where you had these 2 years of price lows at 65, 65, 65, and you read it with a crayon, could draw it, and you went down and blew that low. And so they ran all the stops. They got down to like 55. A couple of weeks later, they came back up to 64.90, 64.80, and tried to push back above that floor. They couldn't do it. Why? Because some guy with his crayon saw that line and said, I'm going to short it there. You drop back down again, not a new low this time. Now you're back up in the 62 area, just sort of not doing much. What we're saying is this. We think that was a bear trap, not a sustainable downside breakout. That when you get back above that price low at 65, like you close a week out credibly over 65, that's wake up time. That's telling you, hey, that was a bear trap. That wasn't real, okay? It was a phantom breakout, exhaustion. Our long-term momentum of crude has structures on it, meaning downtrend structures that are so clear, and you can't see them on the price chart. You can't see the same trend lines, such that you get up around 69 on one of our metrics and around 72 on the other one. It's going to blow out to the upside. And those numbers will adjust down between now and next quarter, such that basically you don't want to get back up in the upper 60s once you get into next quarter if you're a bear. You get back in the upper 60s, you're going to launch. So I think at that point, crude oil, which is now a laggard within the commodity complex, will suddenly get back in line with what the Bloomberg is doing. Not that it necessarily will be an outperformer again like it was 2022, but it'll be strong. It has the momentum dynamics if it can get up to those levels. So I'd say get above 65, wake up. Upper 60s, really pay attention, as we'll be defining breakout structures that should create a real surge, initial surge plus a trend. But it's definitely a laggard right now.
What do you think of Michael's take? Do you agree with him? Will gold and silver blow up and shock the world, especially taking into account that now gold and silver will be legal tender in Florida? Will this be the ultimate catalyst? Gold and silver stackers need to see their stack be worth a gazillion worthless dollars. Post in the comment section down below your honest opinion and share this video with a stacker. Now check this video right here because you'll love it. I'll see you on the other side.